All right, good morning. How's everyone doing? Today is Monday and we're in week 5. And so we're going to start in chapter 12. I don't think we're going to get too deeply into this today. And one thing that I'll probably will be doing is I'll be adjusting the due dates by necessity on the homework quiz and bonus. Not the discussion. I think the discussions we ought to have as scheduled throughout the week, or throughout the week that we're really discussing it. But I'll probably be moving those back a week. I know it sort of coincides with the exam, which is going to be next week, but really I think that's to everyone's benefit. Well, I think maybe I need to trim the light down. There we go. So I think it's going to be to everyone's benefit. And if you want to get started on chapter 12's homework quiz and bonus, you can certainly do that. That's not a problem. But I do think that we're not going to have that much time to get all the way through chapter 12. And really my plan was, and if you look on the syllabus, it just has for week 6, and again, these are sort of standardized syllabi created by committee, frankly. I mean, it looks like there's no other activity but the exam, and obviously we've got class to be held twice next week. So I'll be adjusting the due date. Look for that a bit later today, probably. And you can find that both on the due dates for the activities themselves in Brightspace as well as on the checklist. And so I'll make that adjustment. And you've got until the end of this week to do the homework quiz and bonus for chapter 11, which we've been discussing and which we're just about done talking about in terms of material out of the chapter. There's one additional thing I wanted to talk about, and I think I actually went over a little bit on Wednesday of last week. And I think we were talking about ESG, or environmental, social, and governance issues, and I think I'll do that. And then what I thought I would do is go over some, as I did on chapter 10, go over some example problems and exercises from the back of the chapter in chapter 11, so that if you haven't begun working on those activities in the Wiley system, which again, you just link over from Brightspace. If you haven't begun that, that'll give you a bit of a chance to do that, okay? Any questions about anything? Anybody here or anybody out there in the Zoom call have any questions? You can feel free to give us a shout out. I think we can hear you, and or you can put something in the chat box if you prefer. Again, I'll post the link to this video. I do it under the Brightspace course site. I want to point out one more thing. I mentioned this on Wednesday, and that I had frankly goofed. I messed up. I was not thinking. It's been about a year and a half since I had done an Attend Anywhere section. But for those who watch the video and don't come to the physical class or watch the live Zoom feed, we have to record your attendance. We're just required to do that. And I put attendance links under the discussion tab. So if you go under in Brightspace, in the course site, under coursework discussions, there's no really good place to put it, but we're all sort of used to going to the discussions like anyway to do these activities. I have for weeks 1, 2, and 3, and I'll put week 4 is up later. I do it after the week is over. And all you have to do is just say, I watched the videos on what day. And it doesn't really have to be perfect. It could be 2 different days. It could be 3 different days, but it just is a way to record your attendance. We're required to capture attendance. And then once everyone's had a chance to post to those 3, I'll probably just move those down a bit so they're not quite as prominent on the on the discussion screen. So make sure you do that if you would. Also take note of the fact there's a discussion activity for this week. You want to do that for this week. It relates to chapter 12, and so you've got until Sunday. So there's plenty of time to do it. And on the discussions themselves, the big thing that I would sort of encourage everyone to do is, well, first of all, is not to do too much. That's usually not a problem. It's usually doing too little is frankly where people might get themselves tripped up. But just follow the prompts. These are the prompts that are numbered here. And if you just address those, then you should be in good shape. Sometimes people will get a little bit extreme on this and get into citations and references. And I do not consider it to be a paper at all. It's a discussion activity. It's a participation activity. It's to get people involved in the content itself. And so you've got until Sunday to do it, and then to reply to 2 of your peers, or maybe myself. I usually anticipate a couple of days. I try not to get in there and crowd too much out, but I do sort of sometimes get involved in sort of raising new questions, particularly if there's something that comes up that's relevant. And you've got till Sunday to do it. I know that in some of the sections that involve discussion activities, the initial due dates for the very first reply comes earlier in the week, like a Thursday, like a Wednesday. In this course, it wasn't designed that way. So, but I would sort of encourage you to post sooner rather than later, because if everyone waits until, I don't know, 9 p.m. on Sunday, then you're going to have to be up late trying to chase down people's replies. And I don't think anybody really wants that. I think it's better for everyone to do that earlier rather than later. Okay. So that's a discussion activity for this week. Again, the homework quiz and bonus I'll be pushing back to next week. Next week is also the week that we have our first exam. It's going to cover the 3 chapters that we are going to cover. Leading up to it, the chapter 10, which was sort of the last bit of 2110 that we rolled into this course, chapter 11, which we're going to finish up today. It's an introduction to managerial accounting, and then chapter 12, which takes us into something called job order costing. And we may get into that a little bit today, although I don't know how far we will get into it, just given the fact that it is it's relatively in depth, and I do want to spend some time going over some of the sample homework and that you might see in the back of chapter 11. I'll do some. I've selected some problems to go over, so I'll do that. I know it's not a perfect system because we've got this light shining, and I'm going to have to take everything. I'll take the screen up and whatnot. But I did look back at one of the videos that I posted from YouTube. I just simply uploaded them to YouTube and carry the link over to Brightspace. It looked like people could see it fairly well. You may have to blow it up a bit on your screen, but it looks like it is visible. I was a little bit concerned about that, but it should be okay. And if you can't see it, then give it to me individually and we'll deal with that. Okay. All right, there's a little bit of content I just did not get to on Wednesday that deals with ESG issues. And really, this is more, I think, of a financial accounting piece, but it does come up a bit later, particularly this issue of governance. So ESG stands for environmental, social, and governance issues. And the history of this is a little bit interesting. It was sort of forced on corporations, publicly traded corporations, from the outside, from outside investors, from the society as a whole, from governmental leaders, and now in this country, from the Financial Accounting Standards Board, as well as other regulatory agencies that really want companies to focus on their role in addressing environmental issues, trying to control environmental emissions, et cetera. The social issues, trying to advance equality and opportunity for both the employees as well as the officers and the directors, and in order to better match the makeup of employees and officers to the company or to the markets they serve and whatnot. Unfortunately, I know even in my experience when I first entered the corporate world in the 80s, every single one of the top managers in our company were white males, every single one. And I think the highest ranking female was over a training department, which frankly was not exactly a key operating unit. So women's advancement in the workforce has been dramatic, and some of the very, very biggest companies in the country are run very successfully by women. That's a lot of what the social issue deals with. It's not the only issue, but it's many of them. And then governance really has to do with how it doesn't have to do with government. I know sometimes people look at that and think of government. It's governance. It's internal governance. How does a company govern itself? Are there good controls, internal controls, and is the company obeying the law? Are they acting ethically? Are they creating safe products? And are they involved in creating actual goods as opposed to bads? And I know that sounds a little bit, a little bit sarcastic, but that's not really the case at all. Remember, and one thing, I know I'm going backwards here just a little bit, I did talk about on Wednesday something called the Sarbanes-Oxley Act, which one of the requirements was that it required the CEO and the CFO, that is Chief Executive Officer, who's the top employee, and the Chief Financial Officer, to individually certify a number of things in financial reporting, which are public documents. And they basically are saying individually that they have examined the internal controls of the company, and that the company is operating, with good internal controls, and that furthermore the financial information being provided is accurate, and they certify that individually, and they have personal liability if that's not the case. And I know one of the things that I mentioned on Wednesday is I've had a lot of students say, why is that just now a law? It's about a 20-year-old law, but why is that just now coming into play, and it's a good question why it took so long, but it really happened because of some corporate scandals in the early 2000s that really shook corporate America as well as the accounting profession. And I think that sort of gave impetus to the ESG issues, that is to try to encourage companies to be good citizens as well as profit-making entities. And so we will not deal that much in this course with it, but you may see questions that arise about that as you get it through chapter 11. But that's really what ESG issues are all about, this idea that companies are supposed to be responsible for what they do. Okay? All right, so any questions about that? And that's really all that I had. And I know it's a little bit of a tiny little fragment there of content, but I did want to kind of move on to what I really wanted to mostly focus on today, and that was chapter 11, some problems and exercises. So I picked out some ones that I think are useful, and I won't do these on the board just yet because unfortunately I can't have the text up and be able to operate and be able to, I guess I could move the camera around a little bit, but it's, maybe a little bit awkward, I don't know. But I wanted to focus on some of the practice multiple choice questions. And the first one I want to look at is number 3. This is practice multiple choice. The answers are given, as you know, if you've got the e-text, which we all have access to. You can click on the green box or the blue little button there, and you can get the answer. And what is interesting about that is usually it tells you not only the answer, but sometimes the reason why the other answers are not correct, which I think is an interesting way to present it. So number 3, this is page 1126 in the e-text, is direct materials are a what? Well, okay. Now remember, we talked about this idea of product costs and period costs, and we said that all costs within an organization could be characterized as one of two buckets: product cost or period cost. The product costs are those costs which are related either directly or indirectly to the production of the good or service that the company is trying to produce. Period costs are those costs which are more of a support nature to support, the accounting department, the IT department, HR, those areas that do not produce the product or usually have kind of connections to customers. And so we would sort of put them into that. And then we have manufacturing overhead, which is a series of indirect costs. And we talked about a number of examples. We'll get into that a bit more. So in this case, direct materials are a what? Are they a product cost? Yes, right? They're a product cost. Are they an overhead cost? No, they're not, because they're a direct cost, and hence the word direct cost. Are they a period cost? No. Okay, so that would be what? Yes, no, no. And so the answer to that is B. And if you click on the solution, you probably have seen this before. You get the answer. B, direct materials are product cost only. A, C, and D are incorrect, as direct materials are not manufacturing and they're not period cost. So that's a pretty simple one, but it does sort of address the issue of these 3 cost categories. Remember, when we talk about manufacturing costs, we're talking about direct materials, direct labor, which together are what we call direct costs. You may have this in your notes somewhere. And then we have manufacturing overhead, which is a series of indirect costs. And we're going to be talking much more about overhead and what to do about it. These are all product costs, manufacturing costs, whatever we want to call them. It's the same thing. And I know that I've said before that there is maybe a bias or an emphasis, I guess is maybe a more accurate word, an emphasis on manufacturing in managerial accounting courses. And I think the logic of it is that what applies to manufacturing is easily transferable to service industries as well. And I think that's a realistic assumption, and we'll talk about why that's the case a bit later, okay, as we get deeper into class. That's number 3. Let's go to number 5 here. Which of the following is not an element of manufacturing overhead? Okay, overhead, these are indirect costs. These are costs which are related to the product itself, but they have 2 characteristics. Number 1, they don't really attach themselves to the product, so you can't apply them to each individual product that comes rolling out. Or they are physically attached, but they're so insignificantly small that it's difficult, if not impossible, to trace each individual input to that cost itself as inventory, as if it were direct materials. And so as a result, we just simply drop it into manufacturing overhead. So in this case, which of the following is not? Okay, sales manager's salary. Is that manufacturing overhead or not?
No.
No, it's not. Okay, it's not manufacturing overhead, and so that's really the answer, because factory manager's salary is factory repairman's wages are, and product inspector's salary are. So the answer is A, sales manager. And one of the things that we emphasized, I think it was last week, we talked about this idea that there are some period costs which make them not part of product costs, which means they're not product costs, they're not manufacturing overhead. And we said that a lot of things dealing with selling, whether it's salespeople's commissions and salaries, or advertising or promotional items, are not the cost of the product itself. And I know there is debate that goes on within companies about that. And it's not to minimize the role of those units or those personnel. It's just simply to say, look, if we want to try to get an idea of what it costs us to make a product, then those are costs that are after the product is done, and we should not put them in the cost of the inventory as it's being produced. Now, obviously, it does cost money to sell things, but it costs money to do a lot of things, and so that they don't all become inventoriable costs. Okay, questions about number 5? Let's look at number 7 here, and this is which of the following is classified as a period cost? And we say a period cost because it corresponds to the accounting period in which it's recorded. And again, it goes on to an income statement. Remember, the income statement is this motion picture. It has a starting date and an ending date. At the ending date, we stop the action and we wipe out those accounts and we start again. Okay, and so for, like I say, a year, which of the following are classified as a period cost? Wages paid to a factory custodian is A. Wages paid to a production department supervisor. Wages paid to the CEO, or wages paid to an assembly worker. And this is, if you didn't know and hadn't read this, this would even be one you could sort of logic your way through, because it kind of looks like an SAT question. Which of these don't fit? And that's wages paid to the CEO, because the CEO does not have attachment to the product itself. So the answer to that one would be C. The other ones are people who are involved in making the product. And so C is the answer to number 7. And the explanation was they've included administrative expenses and classified as period costs. And then the other description as to why the other answers A, B, and D are not correct. And so I like that sort of methodology. I'll do a couple that don't have the answers. And so it may be helpful to sort of explain those. Okay. I think I'm going to actually violate what I just said a minute, because I think I'm going to sort of swivel. I wanted to do number 8 because I liked this question, and it's number 8. It's still on the same. It's right down below the one we just did, and it's wages. Where is it? Oh, here it is. For the year, Redder Company has cost of goods manufactured of $600,000, beginning finished goods of $200,000, and ending finished goods inventory of $250,000. The cost of goods sold is what? Okay. Well, let's circle back and talk about what cost of goods manufactured is. And if I could just take one little breakaway here, because I know we've covered this, but it sort of bears repeating. There is a slide which is also in your text, obviously, and hopefully you can see that. But it's this issue of cost of goods manufactured as being analogous to cost of goods purchased, or simply purchases for a merchandising company. But a manufacturing company makes things, a merchandising company buys things that are already made, things as an inventory. So when we talk about this idea of how we get to cost of goods sold, and we covered this back in the accounting 1, we start with beginning inventory as of, if it's the calendar year, fiscal year, it's January the 1st, plus all the goods we purchased during the year. Together, those equal the goods available for sale. We take out the ending inventory, the goods that did not get sold. It must mean that what is accounted for is the stuff that was sold. That's what cost of goods sold is. This is the first time that we recognize cost of inventory. It's when the good is sold, because remember, product costs, even in merchandising, are tied up in inventory as an asset until those goods are sold. Okay. It's an asset account until the goods are sold. And it's an asset because it has future service value. Well, the analogy to this is manufactured goods. Manufacturers will sell finished goods, but the difference is they're putting these goods together. It's a little bit more tricky, obviously, but it's the same idea. We start with beginning finished goods, plus the cost of goods manufactured, which is basically the cost of what it took all year long to make finished goods. And some of them weren't finished, so we have an ending, or some of them were finished or were not finished, which means they're in an inventory account back on the balance sheet. But we're on the income statement here, and we take out the finished goods that were still on hand but were not sold, and we arrive at cost of goods sold. Cost of goods manufactured is simply one of the steps on the way to get to cost of goods sold. What makes cost of goods manufactured different in a manufacturing context is the idea that the accounting for that is obviously more involved, as I mentioned a minute ago, but also it's not usually broken out on an income statement. I know in the chapter it had some example income statements where there's a lot of detail about how we used cost of goods manufactured and we got to cost of goods sold. Usually that's captured on internal schedules, okay? That's usually what's going on. They're captured on internal schedules more than they are on the income statement. And I'm not saying that some companies don't get into great detail when they do reporting, but that's typically not really the case. So anyway, back to number 8. Okay, so the question is, what is cost of goods sold, given that we've got all this information together? Okay, so let me do this, and I'm going to see how this works out, because I know I'm still kind of new in this room here, and so let me kind of zoom in a bit if I can, and I'm going to try to go over to this board here. And let's do some of the numbers. And so we're going to start with beginning the same methodology that we used for, and remember when I gave you the ending inventory and cost of goods sold formula, which you probably have now in your notes, I said it's as much a methodology as it is anything else. It's a way that we get to some final value. So if we start with beginning finished goods here, and we add to that the cost of goods manufactured, which is analogous to purchases, then we're going to get goods available for sale. Okay, but we're not really worried about that. We are worried about taking out ending finished goods, and then we're going to arrive at cost of goods sold. Okay. And so what are these numbers here? So we start with beginning finished goods, and what is that number? It's 200,000, isn't it? Where are we here? Cost of goods manufactured. Beginning finished goods was 200,000. So let's put this in 200,000. And we had cost of goods manufactured 600,000. So the total cost of the goods that were available for sale are 800,000. And we're going to take out ending finished goods, which was 250,000. So we're going to subtract that 250,000. So what do we end up with here? We should get cost of goods sold of 550,000. Okay, so 550,000 should be the answer, and let's pull it up here and see if that's what the textbook authors get, and they do. And we walk through this idea of how we got to that answer. Again, it's kind of a methodology as much as it is anything else. And hopefully that's bright enough for you to see on the board there. If not, I can always give you that formula again at some other occasion, but the rest of the problems for the most part, I'll try to do on the within the light here, so it's visible. Okay. Okay. Let's do one final thing here. Let's do 12, and then I'll go on to some others, and let me kind of swivel the camera back here, and let's do number 12. This is private practice multiple choice question. I got a bunch of ants everywhere here. It's like the second ant I've had to deal with, so I don't know why we put ants in this building here. Bring an exterminator. So number 12, after passage of Sarbanes-Oxley, which we talked about before, the 2002 law, which did a lot of things. Then what? Okay, after passage, then what does it require that people do? The answer is, and the big one, I believe it's called the Section 440, is B, CEOs and CFOs must certify that financial statements provide a fair representation of the company's operating results. And there are some other things that they are certifying. And I know that in some cases, there are some companies that looked at this law and said, you know what, maybe we don't want to be a publicly traded company, and they took themselves down from the listing. In other words, they delisted themselves. They're no longer trading on the New York Stock Exchange or the NASDAQ, and I think Chrysler was one of those And they changed the name a couple of times, but I think that was one of the things that was a concern to a lot of people. Okay. All right. Let's take a look here. I want to sort of drop down a little bit and go to practice brief exercises. And I want to look at this first one here. It's a fairly lengthy question, and it deals with a lot of different areas. And so I'm going to just go over it quickly. I'm going to take the screen up here so that we can work the problem. But it's practice brief exercise number 1. And I know that we got all these different categories of questions: practice multiple choice, practice brief exercise. So I know it's important to know which one we're talking about. This is number 1. Following are selected data for Lopez Furniture. So we've got utilities, and we have wood, which it's a furniture companies they manufacture. So I would imagine it's direct materials, depreciation on the building, the factory building, wages for the production workers' fabric, which is likely a direct materials, delivery expense, and property taxes on factory. I like this one because it's really got a lot of everything in it, and there are a lot of different elements of this. And so in this question, what are we being asked to do? And this looks a lot like one of the ones that you'll see in the Wiley system. So determine A, direct materials, B, direct labor, C, manufacturing overhead, D, product costs, and E, period costs. Okay, so there's a lot of things going on there, and I'm going to simply do those. And I'm going to take this off the screen here so that we can have a look at this. And so, and obviously for those watching on the video, you can, obviously flip back here. So this is practice brief exercise number 1, okay? And let's go ahead and work this, okay? So we've got, first one asks us for direct materials. And so of these, there are only two items of cost that are considered direct materials, and that would be wood and fabric. At least that's the way it looks to me, certainly. And so, and for the wood, we had cost of $850,000, and for the fabric, we had cost of $313,000. So together, simply adding these up should be a relatively simple matter: $1,163,000. Those are the direct materials costs for that particular accounting period. Those are direct materials, and obviously there are an element of product cost. So those are the figures for that. So that's A. Okay, that's A. Let's do B here. B is simply direct labor. Well, direct labor is easy, and the reason why it's easy is because there's one line item it's production wages, and that was just given to us at 391 or 391,000. That's easy peasy. And again, one of the things that I had mentioned before, and it really is, I think, a useful thing to remember, is that wage costs are really not that difficult for us to get our arms around. They're usually given to us, and there's usually not a whole lot of calculation. If you're doing cost accounting for production operations and you need to get labor, it's usually readily available. And mostly because firms have an obligation to pay workers accurately, to record their time, and it affects their benefits and everything else. So that's usually not a problem. Okay, manufacturing overhead is the last of those. We have 3 items here. We have utilities. These are not utilities on the headquarters. These are manufacturing utilities, electric, power, and water, etc. That was $120,000. We had depreciation on the factory building. So again, this is not depreciation on the computers in the HR department, back in the home office, and wherever. It's depreciation on this factory building of $220,000, and then property taxes on the building itself and structure. That's the factory, okay, and that was $70,000. So together, manufacturing overhead is $410,000. And again, the math is relatively straightforward. And use a calculator. There's no reason why you should try to do these by hand. And if you want to do it by hand, that's fine. But I think I would check my work with the calculator, just because why not? So okay, so that's A, B, and C. In other words, direct materials, direct labor, and manufacturing overhead. Okay, those 3 elements of product cost. D asks us for all product costs together. Well, okay, well, that simply is giving us doing a roundup here of all the product costs that we just computed: direct materials, direct labor, and manufacturing overhead. And so all we're doing is simply moving over the answers for 1, 2, and 3, or for A, B, and C to part D. So direct materials was 1,163,000. Direct labor was 391,000. Manufacturing overhead was 410,000. So if you add these together, that's a 410,000. We should have total product costs of 1,964,000, and those are total product costs. Where do those costs go? They go into inventory accounts until those goods are sold, and eventually they'll end up as finished goods, which is part of inventory. And then when that inventory gets sold, it'll be released as an expense on the income statement. And then that will be the death of the recording of that good once it's sold. Once it leaves the manufacturer, it's no longer manufacturer's problem to account for it. It belongs to someone else. Okay. And then the final one is period costs. And period costs are not inventoriable, they're not part of the product cost itself. And there's really only one of those, and that's delivery expense. That was given to us 144,000. Remember, delivery expense, which in this case is the period cost. Remember that delivery expenses are also known as freight out, and freight in, which you may have remembered from 2110, is a cost of the inventory itself. It's a cost of getting the product available for sale, or available to be worked on to be available for sale. So it's a product cost. And once the product is done, we're no longer capturing costs into that good because the good is done. So freight out, if the company is paying for freight out, then it becomes a period cost, like a lot of other costs, like insurance on the building and on the factory, or I'm sorry, insurance on the headquarters and the CEO's salary and HR expenses and all of that. All right, and by HR expenses, I mean administrative costs, which do not attach themselves to the property itself. Okay, so that's the answer to, that's what number 1 looks like in the the practice brief exercises. Any questions I can answer for anybody on that before I do a couple more here? Let's go. I want to look at, because I'm going to try to, I did a bunch of them, and I think it's probably useful to do maybe another 3 or so. And I want to look at practice problem 3. Okay, let's take a look at that. So this is practice. So if you go to the text, practice problem 3 is found somewhere down here. And where is it? Did I just pass it? Oh, it's right here. Okay. And all right, so it's this company, it's called the Superior Company. This is on 1127, page 1127 in the and I know I've got a bunch of stuff up here on the board, and I'm going to erase it, but let me go ahead and before I do that, I just want to kind of take a quick look at this, and then we'll do the problem. So there's a lot that we need to do here, and so let's take a look at this. So we've got a bunch of inventory data that's all sort of captured within the different values, both beginning and ending. So we're saying this is for the year ended December 31st, 2027. So we've got those elements of inventory for goods that are being manufactured. Again, this is a manufacturing operation. So we have raw materials, we have purchases of raw materials, we have work in process, we have finished goods, we have direct labor, we have all kinds of stuff here. And so the question is, prepared cost of goods manufactured, an income statement, and a partial balance sheet. Okay, so there's quite a lot going on there. And so why don't we do this one? Only because I want to be able to show in an example problem what the relationships are between these costs and how we eventually move them over and record them in a financial statement. So, all right, so let's do this one. This is the Superior Company for the year end 2027. Again, we, for whatever reason, use dates in the future. So, all right, so let's do this. We're gonna prepare a cost of goods manufactured. So let's do this. We're going to start with work in process. We're going to start with beginning work in process. Now, remember, when we are talking about the inventory accounts, okay, and this is going to be beginning work in process, that we have raw materials, we have work in process, and we have finished goods. Those are inventory accounts. And those shouldn't be confused with direct materials, direct labor, manufacturing overhead. Those are costs which are absorbed that work their way into these accounts. Those costs are cost items that we dump into inventory accounts. Because remember, product costs are what we call inventoriable accounts. And so when we start with this, so let's come out here and we're going to start with beginning work in process. Because remember, we're trying to get our way down to cost of goods manufactured. And what is cost of goods manufactured? It's the cost of making what are ultimately finished goods, because you can't sell goods that are not finished. And so that's really what's going on there. So we have 80,000 that was given to us on that big listing of counts and values. And then let's do the product costs. Okay, so we've got direct materials first. And I'm going to start with raw materials. So we have raw materials. And again, we talked a bit about raw materials as being maybe not something right out of the ground or whatever, but they could be already finished goods, but they're raw to this company. And so we start with beginning raw materials here of 30,000. And we purchase new raw materials. And so we have raw materials purchases. So we're adding to this because remember, we're talking about the three elements of cost, direct materials. And so we had purchases of 205,000, which gives us then a total raw materials. Raw materials are available, and available for use, we could say, that's 235,000. And then we're going to take out ending raw materials. Again, using that very same, what we would call a methodology, that's the ending. And that was 20,000, so we want to take that out, and we get then 215,000. Okay, we get 215,000, and that's the cost of direct materials. Okay, I'm just kind of want to keep our columns straight here. So 80,000. Okay. Beginning raw materials plus purchases minus raw materials available, and so we end up with materials. And if we talk about direct materials, raw materials, that's they're simply physical items, physical inputs that we're using to make some sort of output. So we end up then with 215,000. Okay. The next element in the product costing scheme is direct labor, and again, as I have said before, that direct labor is one of the easiest of all, and so we're sort of given that, and that we're given that as 350,000. So let's bring that over here. There's not much that we really need to do there. And then we have manufacturing overhead. So direct materials, direct labor, manufacturing overhead. Now we've got a bunch of different things here, and I don't really have a lot of board space to do this. That's sort of a handicap that I've got. But let's just kind of walk through. And I'm going to kind of summarize just because I don't really have the board space. But I've got, what do we have that falls into manufacturing overhead for this year? These are indirect costs. And so we have the factory manager's salary of 35,000. We have insurance on the factory, that was 14,000. Property taxes on the factory of 6,000. Indirect labor, which could be incidental labor, it could be things like security guards, inspectors, whatever, 105,000. Rent on the factory machinery, utilities in the factory, 65,000. The rent on the factory machinery is 40,000. Utilities in the factory was 65,000. And factory depreciation was 24,000. Altogether, I'm just going to summarize these just because I don't really have very much room here, is 289,000. Okay. So just kind of think about this as to where these numbers came from. We have 1, 2, 3, 4, 5, 6, 8 items, or 7 items. Factory manager's salary, insurance on the factory, property taxes on the factory, indirect labor, rent on the factory, utilities on the factory, depreciation on the factory, and that gives us 289,000. Okay. If we add all these guys up here, we have total manufacturing costs. Okay. So this is very analogous to goods available for sale, sort of. And let me make this a little clearer here. Total manufacturing costs, which in this case are these, all these categories added together. Okay, and so we end up with 854,000 out here. And if we take the 80,000 that was beginning and we add these new manufacturing costs, we end up with the total cost of work in process throughout the year of $934,000. Okay, 934. And we're almost done, so I'm just going to kind of move this up here, and we've got total work in process for the year of 934,000. I'm just moving this up here, just to kind of make use of the board space, okay? And so this was the total that was being worked on throughout the year. We want to get the cost of goods manufactured, that is the goods which were produced as finished goods during the year. So what do we do here? We have to take out the ending work in process, okay? Let's take out ending work in process because it's still being worked on. We cannot call it a finished good, it's still being worked on. And that was 50,000. So as a result, we take 934 minus 50 and we end up with 884,000. What is that number? That is cost of goods manufactured. Cost of goods manufactured. And that's basically the equivalent or the analogy to the purchases account for a merchandising company. It's the cost of new products that hit inventory and throughout the year, some of which were sold, eventually some of which were not sold. And we're going to keep on working with this particular value, but does everybody see what we did here? We're trying to get to cost of goods manufactured, and manufacturing costs we know are comprised of direct materials, direct labor, manufacturing overhead. When we've got direct materials, in this case, we're just sort of given raw materials, same thing really. Beginning plus the purchases gives us total available minus the ending. Again, using that very similar methodology of that we use in a periodic costing system. Periodic meaning we, at the end of the accounting period, we go back and we do all the math and figure out what things cost us. So we have direct materials, direct labor, which was given, that's easy peasy. Manufacturing overhead, which I summarized for you to get 854, plus the beginning work in process gives us total work in process for the year 934, minus the ending work in process gives us cost of goods manufactured. And we have to take this out because these are the goods that are not quite done yet, okay? They're not quite done yet. So there's a lot going on there. I know that, and but that's I think pretty representative of some of the problems that we'll see throughout the Wiley homework. And I would just sort of encourage you to take your time on that and sort of look at it. I know that it's a lot of people find it to be a little bit challenging. Sometimes it doesn't like commas. Sometimes it doesn't like a lot of things. You have to kind of play around it to make sure it gets input correctly. But we have had other publishers, companion sites that have been actually much more difficult to work with. So we kind of feel lucky with this one. So believe it or not. Okay, that's the first one. That's part A of this very long problem of the superior companies. Does anybody have any questions about how we got to cost of goods manufactured, 884,000? Okay, well, then we're asked to do an income statement, and I'm going to do an income statement. I'm going to erase this. I know that, does everyone have this? And by the way, if you don't, if you're in the room, you can get up, take a picture or whatever, but it's also going to be on the YouTube video so you can see that. Again, the YouTube videos, all you do is, you don't have to go to YouTube, you'll be carried to the video. The video will be is linked out of YouTube to the Brightspace site. You just have to go find the module and go all the way to the bottom of that module in Brightspace, and there'll be a number of links, and they're not password protected or anything. You can watch them as many times as you like. If you really want to do that, you're fine. So, all right, let's do B. This is the same problem. We're going to do B here, and it's going to be an income statement. So, I think you'll find this to be a little bit more compact here. So we're going to start with an income statement, and this is an income statement that is prepared in accordance with GAAP, generally accepted accounting principles. And so it's going to have the format that we all know. Sales or revenue, whichever you want to talk. These are simply the value of the outputs that are sold. And we have your sales of 1,500,000 throughout this year here. And because we're a company that sells physical things, we're gonna have a section for cost of goods sold. So let's include less cost of goods sold, COGS. But in this case, that's a little bit challenging because we've got beginning finished goods. Okay, and we want to sort of input that. So we had beginning finished goods here of 110,000. We had, and that was simply given in the case, the beginning finished goods. Remember, we're talking about goods which have been sold. So we got to go through this methodology of beginning finished goods plus new goods equals total goods available minus the goods which didn't sell. And we get the cost of goods sold. Okay. So let's do it. So we start with this. We don't have to figure this. It's given plus cost of goods manufactured, which is analogous to purchases in a merchandising context. We just calculated that at 884,000. So we just did that. So we had goods available for sale of 994,000. Okay. Beginning finished goods plus cost of goods manufactured. Remember, cost of goods manufactured is the cost to make a good all the way to from start to finish, right? So when we get into raw materials and direct labor and all the elements that go into manufacturing overhead, those are all inventoriable costs. And so we put them into cost there. And since we started with beginning finished goods, we're going to take out ending finished goods. Okay. Because they're done, but they didn't get sold. So if they didn't get sold, we can't call them cost of goods sold. And that was 120,000 that's still on hand. So it's going to go still on the balance sheet. And we're going to end up here with cost of goods sold 994 minus 120 is going to give us a figure here of 874, I believe, yeah, 874. And it's cost of goods sold. So this is the figure for cost of goods sold. So 1,500,000 minus 874. And remember, if we go back to our earliest introduction to income statement, sales minus cost of goods sold is gross profit. Gross profit is expressed as a dollar figure. You might recall gross profit percentage is a percentage, sometimes called gross margin. So 1,500,000 minus 874,000 gives us a gross profit of 626,000. Okay. And then we take out operating expenses. And so I'm going to move this up here. Okay. And I'm just going to simply recreate this I like to make this as big as possible, but in doing so, I run out of board space. So we have 626,000 over here for gross profit. And I want to take out some operating expenses, okay? So less operating expenses. And these are sometimes, they include a lot of things like administrative expenses. Because remember on the income statement, we said we had a 3-step income statement. The first step is to compute gross profit. Sales minus cost of goods sold equals gross profit. That's the first step. The next step is to get to operating profit, which is gross profit minus operating expenses, which include things like salaries of support personnel and things like rent on the building, freight, advertising, maintenance on the home office, all those kinds of things. And so in this case, we just have to simply copy what is given to us. And so what do we have here for operating expenses? We have administrative expenses, and that could be a lot of different things. You think of it as being a lot of times dominated by wages and salaries, and that's probably a big factor. When we get into talking about service industries, we're going to see that the biggest expense by far in service industries are salaries, wages, benefits, all that, because they don't make inventory. So there are no raw materials or manufacturing overhead. There's overhead, but there's not the same kind of concept. We have sales commissions, right? Remember we said sales commissions are not product costs. So we have sales commissions. And that was given to us 150,000. And finally, delivery expenses or freight out. Delivery expenses, and that was 100,000. So together, those costs were 550,000. Okay. And if we subtract, take 646 minus 550,000, we get net income of 76,000. The only part we don't have here on a three-step statement is because we would call this operating profit unless we had this figure, 76,000. We would call it operating profit unless but if we are not given non-operating items like interest, gains on things, losses on things. We're not given that, so we don't have to worry about it. Also, in that third step after operating profit are things like taxes and whatnot. We're not worried about that. In fact, taxes are really not that much of an issue in this course at all. But that kind of gives you the bottom line. So this is sort of an income statement that follows the format we've seen before from accounting one. Sales minus cost of goods sold equals gross profit minus operating expenses gives you net income. And if we had other non-operating items like gains, losses, interest, dividends received, all these other things which have nothing to do with running the company, or which impact the income statement of the company for the year, it would drop below that. And also we'd have taxes. And so just to sort of reveal, this is an abbreviated income statement, okay? It's abbreviated in this regard. Now, what is a little bit different, and I think I've said this before, is that increasingly, and I've been doing more and more looking around at companies' financial statements, particularly manufacturers, and sometimes they're not really getting into cost of goods manufacturing. If they do, on the income statement, and if they do, they are sort of burying it in the notes, which people can find. It's not like it's hidden information, but it's in the notes. It's not really broken out, and companies want to make these statements as compact as possible, even very large companies. I was looking at Boeing the other day, and they don't have a cost of goods manufactured account on the income statement. Clearly, they manufacture aircraft, so they're going to have cost of goods manufactured, but they're trying to simplify, and it has been a long-standing practice among companies that have competitors, which is pretty much everyone, that they feel like some of this information is strategic, it's confidential, they don't want the world to kind of see what is going on, okay? All right, A, B, and C are what's being asked for in this, and the first A was, what is cost of goods manufactured? So part A of this, and we're still on this Bob Superior company, we did cost of goods manufactured. Part B was to do an income statement. Part C was to do a partial balance sheet, which takes us really only to current assets. And so I'm going to do that. You know, everyone okay for me to erase on here? Okay. I'm going to go ahead and erase, and let's just do a little balance sheet. Again, the purpose of this one, which I think is a really worthwhile problem, is to get us to go from capturing costs, which are manufacturing costs, to their ultimate impact on the financial statements. Even though we're not dealing that much in this course with preparing income statements for external use because it's a financial accounting function, but we are trying to link these internal functions and recordings and reporting to that ultimate function, which is external reporting. So part C, we're going to do a little balance sheet here. We're given some figures, and I think we're just going to take this up to current assets. I don't think we're given any more. We have, let's see, a cash of 17,000. This is as of, remember, this is a balance sheet, so this is going to be as of a certain date, 12/31, right? Balance sheets are snapshots. We're also given short-term investments. And we haven't really talked about that much in this course, other than the key word being short-term, that is convertible to cash within a particularly quick period. And that was 26,000. I'm gonna move this over here because we're gonna do some things with inventory in a minute. So we have cash of 17,000. All right. 17. This marker is kind of losing its luster here. Hopefully I have some others. And then we have short-term investments of 26,000. And we have accounts receivable of 120,000. Okay, 120,000. Now remember, when we talked about back in chapter 10, we said, okay, current assets are first of all, assets are those resources that are owned or controlled by a company and which have future service value. And those which are considered the current assets are those assets which can be converted to cash within a year or the operating cycle, whichever is longer. Usually a year is pretty good. It's a pretty good picture to figure it out. And we said they're really big. The big three in current assets are cash, accounts receivable and inventory. We're going to get to inventory in a second. But there are other items of interest. In this case, we're given short-term investments. Prepaid expenses are another one, and insurance is usually the big component there. It's just the unique nature of that. So, so those are some things to think about that, and I think part of the battle when it comes to accounting is to recognize, what does this account do? All I have is a name. What is this account? Is it a balance sheet account? Is it an income statement account? Is it an element of cost? What is this? Okay. So in this case, we've got inventory and on a balance sheet. Remember, these are balance sheet items. So we're gonna break these out into their categories here. We're gonna do finished goods. We're gonna do work in process and raw materials. Now remember, these are not going into the income statement just yet because they are working their way through the production process. Finished goods are done, but they haven't been sold yet. So until they're sold, they're assets, all the costs being inventory that's dumped into those costs. When they're sold, then they'll be released on the income statement. They'll leave the balance sheet and they'll hit the income statement, and the good will be done and gone forever, never to appear again. So we have, in this case, we're given finished goods of 120,000. Work in process of 50,000. And we're going to talk much more about the WIP account and the series of accounts that involves. And we have raw materials of 20,000. So together, those inventory is 190,000. We have one more balance sheet item, that's prepaid expenses. And this is the only time expenses really will show on an income statement, because they're prepaid. They're what we call deferrals. That is, don't follow the money, follow the activity. We paid ahead of this. We paid ahead of time, so it's an asset. Insurance is really oftentimes the biggest one of all. It's one of the very few goods that has the unique and strange nature of having to be paid ahead of time. Prepaid expenses, 13, we don't know what they are. Could not, maybe it's not insurance, I don't know. But add all these together, add this together, 17, 26, 120, 190, and 13,000. And we end up with total current assets of 366,000. And you can check my math on that and make sure that's right. It's 43, 163, 353, 366, yeah. 360, and that's current assets, okay? And that's just a partial balance sheet we're being asked to do on this one. That's really good for that, okay? So that's a fairly lengthy problem, but it's one that I think is representative of a lot of the things that you'll be asked to do in the homework quiz type situation in Wiley. And so I think that's pretty representative of what's going on. The thing that I think is useful, and it's really to your advantage here, to have all your resources available when you do these problems. Obviously, the e-text is there. You have a physical text that's yours to use, obviously. Your notes, and so just kind of find out. We've done this before. Find out where it's been done, and then simply do on the problem. And I know that all these problems are not going to be exactly the same. In fact, some of the ones that I will do throughout the course in class may be identical questions that you'll face in the homework quiz and bonus. And if that happens, then it's purely accidental. I usually don't look at the problems as they're assigned. What may change are the numbers. It uses an algorithm to change the numbers around. They're just it's loaded into the bank and just sort of hits you randomly. So the person next to you may have different numbers, but it's the same problem. Okay. All right. We've got about 15 minutes left, and I do want to do a couple more here, and these are not ones that involve calculations at all. So I'm just going to bring down the screen here so we can do these, and these are going to be in the brief exercises in the text. And let's look at these. So this is brief exercises, and so it's around page 1130 in the e-text. So, or 1132 in the e-text, and I want to do brief exercise 11.4 and 11.5. Okay. And this is a good one. This is one that looks a lot like quiz kinds of problems, so to speak. So in 11.4, it's got a number of different items These are just cost items, okay? And the question is what to do with them. And so in this case, it asks us to classify manufacturing costs, indicate whether each of the following costs of an automobile manufacturer will be classified as direct materials, direct labor, or manufacturing overhead. Okay, and we're given A through H here. So let's do that. So we've got a company that makes cars, okay, and so the windshield, what is that? That should direct materials, yeah, direct materials, no question about it. The engine, direct materials, and no question about that. Wages of the assembly line worker, direct labor, yep, exactly. D, depreciation of factory machinery, manufacturing overhead, no question. Even though it's a financial cost, and you don't write a check for it, it's a number, it's a cost allocation. It's done on the equipment used to make the product, so it's manufacturing overhead, it's a product cost. E, factory machinery, lubricants. Well, this should it screams manufacturing overhead because it's among those products like glues and paints and all that, that it's really hard to trace to individual products, and so as a result, they're just simply accounted for as manufacturing overhead. So E is manufacturing overhead. F is tires, direct materials. G, steering wheel, direct materials. And H, the salary of the painting supervisor. Okay, these goods are being made, so that would be what? Manufacturing overhead, because presumably that person sort of presides over a lot of different areas and different people, and when you have this, it usually becomes manufacturing overhead. If you could take this person's salary and link it to product, you could make a strong case for it being part of direct labor, but you'd have to be able to do that. In this case, we're going to assume it's manufacturing overhead. And I think that because we've talked about some of the examples of salaries and wage costs which align themselves with manufacturing overhead, this would be sort of a logical way to go. Okay. All right, and the final one is 11.5, right below it, and we're given A through F of costs, and these are categories of costs. These are not, while these things are individual line items that will go into inventory. These are all product costs. Every one of these are product costs or manufacturing costs, whatever. It's the same thing. Okay. Here you've got some costs that are either going to be product costs in these areas, or they're going to be period costs that are just simply accounting costs that are incurred in order to do business generally. So A is manufacturing overhead. Well, that's product cost. So that goes into that category. Selling expenses, product or period? Period costs. Along with administrative expenses, things because these are not cost, and advertising also period costs because they do not go into making the product, that they're incurred independent of making the product itself. It's more of a support role. And selling expenses is oftentimes a very large figure. It's oftentimes the compensation of salespeople and promotional efforts and all these things. And some companies go to extreme lengths to sell their product, and so but they're after the product has been made, so, and they are independent of the production process. They are support folks to get the product sold. And direct materials and direct labor, E and F, are both manufacturing costs. So those go or product costs, whichever you prefer. Okay. All right. So any questions about any of those? I think that is. There are a few more that I could do. Does anybody want to see more, or have you had enough on this? Okay. I think that's a pretty good sort of roundup of the costs that are involved here. There's another one I was going to do, and I liked it. I don't think I'm going to have time. I have 11 minutes, and I don't think I'm going to have time to go through it. So I think I'd rather not. But if you look at exercise 11.9, which is on page 1136 in the e-text, that's a really good one because it goes through work in process, all the manufacturing costs, taking out work in process, getting cost of goods manufactured. But it's very similar to the one we did with the Superior company. So I don't know that I have time to do it. I will say this: if you want to see it and want me to show it, I can do it. I can always come back, and I can even record a bit of video on that and post that. It's not a problem. It won't take me, it's about a 15-20 minute thing. No big deal. It's not like I've got other places to be, but I can't do that. I just don't think I can fit it in here. Okay. All right, so so that really does it for chapter 11. Any questions I can answer for anyone, either here in the room or on the Zoom link? Okay, well, let's do this. Let's get into chapter 12. And we have about 10 minutes, I guess. And I want to just sort of get into what chapter 12 is, introduce it. We are going to spend pretty much this week and the next talking about job order costing. And if we get through, it's a fairly lengthy chapter in a lot of ways, and it's fairly detailed. And I don't want to rush it too much, but I do want to be thorough. And if we have questions, I want to be able to talk about what those are. Okay, so when we talk about job order costing, the thing we should know about this is it's a form of costing that is very specific to a job, which is as the name implies. And I'm going to talk about how this differs from other kinds of costing, and it lends itself to particular kinds of activities. In particular, it's really dictated by what kind of good a company is making, or service, I might add, because we're going to talk about some non-inventoriable items, but still would be able to apply job order costing. So this course is not strictly dedicated to manufacturing, that these same concepts can apply both to manufacturing as well as service businesses. And this is one that we'll talk about what it is. So anyway, we've got 5 learning objectives in this chapter. And we're going to talk in general about the first one today. We're going to talk about these general cost systems and talk about how we absorb costs as a particular job is done. And what's interesting and unique about this is this applies to companies that don't do mass production, but instead do tasky things like maybe a construction project or remodeling project or a motion picture. These are not things, you don't do millions of units, you do a few units, and because of that, you're trying to capture the cost. And so we'll talk about what that system is. We'll talk about how we account for the costs as the product or service is being created using what's called a job cost sheet, which really anymore is more of an electronic item. We'll talk about how to use overhead and what we call predetermined overhead, and that's going to be a lead into this whole notion of the budgeting process. And then we'll talk about what we do with these costs once they're sold, how they hit the income statement, and then we'll talk about variances, over and under, and that's going to be also a lead into some other concepts that we'll be talking about as we get going throughout the class. So let's talk a bit about cost accounting. So we have said before that sometimes accountants will refer to managerial accounting as cost accounting, mostly because there's such an emphasis on cost, and it really focuses a lot on the issue of controlling costs, accounting for them, understanding what the costs are, and then from an accounting sort of task perspective, a series of what ifs that deal with what if costs did this. But what makes managerial accounting a little bit more comprehensive than pure cost accounting is that we also bring revenue into the picture, inflows from selling goods. And that's how it differs a little bit from cost accounting. Cost accounting, by the way, is a course that we offered here because we offer all the courses leading up to the CPA exam. I think it's 2240. I don't teach it, but it's I've taken it back in the day or something like it. And it is purely focused on cost and what to do about costs and how to measure and how to manage it. So when we talk about cost accounting, we're talking about sort of accounting for the various costs of doing whatever it is we're doing. Remember, inputs into a process create costs. Outputs create revenue. So we're going to focus on inputs and the costs which associate with them. Inputs, though, can oftentimes be measured in countable units, hours put in, as in direct labor, materials measured in terms of pounds or units or whatever. But costs are always dollar figures as we move along our production process. And I want to come back to this idea of perpetual versus periodic inventory systems. We haven't talked very much about perpetual systems so far in this course, but remember when we talked about systems that record inventory. Up to this point, we have been working with a periodic system. It's called a periodic system because we go back sometime after the accounting period is over, and we figure out what cost of goods sold was during that period. And as part of that, we find what ending inventory is. We have to do a physical count in order to make that work. A perpetual inventory system is one where you get immediate, almost real-time information as to what inventory is. And if you know what inventory is, you know what cost of goods sold is. And if you know what cost of goods sold is, you kind of know where you are profitability-wise at any point in time. Perpetual systems really only work with technology. You can imagine back in the day, there was no easy way to record the immediate entry and sale of inventory on a real-time basis. And so perpetual inventory system is used by all the big retailers. It captures goods as they're being sold, and as new goods are arriving, the inventory account itself is updating. There is no purchases account, in other words. And it captures everything in more or less real time. And so we've got these ideas of different kinds of systems. And I know this is one of the areas where it's important for us not to get sort of lost in the idea. We've got comparison. We talked about, we have, when it comes to inventory, and I said before that inventory presents a special set of problems for accountants. We've got the cost flow assumption, LIFO, FIFO, average cost, et cetera. And then within LIFO itself, lots of different kinds of costs. Okay, but that is a costing of inventory, making an assumption about how inventory is moving. Okay, finished goods, right? We've also got periodic and perpetual systems, which are basically when and how we're accounting for inventory, regardless of whether we use FIFO or LIFO. Perpetual systems are used with technology in order to update inventory in real time. Periodic systems go back after the fact. And then we've got another set of sort of a dichotomous pair, and that's process costing versus job order costing. Process costing, which we're not going to cover in this course, is one in which we've got lots and lots and lots of output being produced on a more or less continuous basis. And as a result, we are costing it based upon whatever the process is over some defined time period. Whereas job order costing, it doesn't matter how long it takes until the job is done, whatever that job is, whether it's remodeling a kitchen or detailing a car. We're not finished costing it until that job is done. Okay, so process costing system, and this will be a good jumping off point for us to get into the job order costing. Process costing is used whenever you're producing lots and lots and lots of items. Some examples: cereal, petroleum. I mean, you're just talking about lots and lots of output. And so at some point, you've got to say, okay, time period's up. We're going to calculate all the costs we've incurred to make those goods, right? Using all the same categories of direct materials, direct labor, but we're going to cut it off at some point because we want to cost it for that particular time period. But all the goods tend to be mostly homogeneous, okay? They're not customized, in other words. These goods they're all the same. Cereal, Quaker Oats cereal is the same as all Quaker Oats cereal. It's not different in Arkansas than it is in New York. It's the same, right? So it's for a time period. And we eventually will assign these to individual departments, okay? And that's what process costing really is. And so it's not that different than the logic of what we've done before. And that is, as a good goes all the way, in this case, we've gone pretty far back to harvesting of whatever this is, potatoes. I guess we're making potato chips, to cleaning the product, to slicing it up, to all this to make potato chips. And since potato chips are mostly the same, and by the way, companies go to great lengths to create the identical experience for the products as they're being produced, they are all the same. So it's a matter of saying, okay, well, your unit in San Antonio produced this amount of volume, and so we're going to say this was the cost of that big process. It's for mass manufacturing primarily, for mass production, okay? And that's what it is. And this differs from job order costing, and this will be the last thing because we're just about out of time. And that is, we're assigning costs to each individual job, regardless of how long it takes. And so it's not for a set time period. And that we're going to capture the cost as we're doing it. These are unique outputs. They're not identical like potato chips or or petroleum or whatever they are different, okay? So that'll be where we start when we come back on Wednesday. We'll spend the rest of the time Wednesday going through some of the basics of job costing. And we'll do that when we come back. And we'll probably continue that discussion off into next week. And hopefully by Monday, we'll do some example problems and exercises. And whatever we don't get done Monday, we'll carry that into Wednesday. I do want to review for the exam. And I'll probably give myself 30 or 40 minutes before the end of the class session on Wednesday. The exam is going to be available Monday, but let's not worry about the exam yet because we still got one more chapter to get through. And I'll go over and do a bit of a review session on Wednesday. Okay, next Wednesday. Okay, any questions before we wrap it up? I think I went a minute over. I got to quit doing that. I'm going to keep you too late. Okay, if you do have questions, feel free to get with me. Otherwise, we will start with the basics of job costing on Wednesday. Have a great day.